What's going on, guys? Bryant here. Today is Tuesday, October 19th, 2021, and the market is closed. Now, whether you're new to trading or you're an experienced trader, there's one thing that you really need to understand, and that's supply and demand. Now, there's a lot of content circulating out there on how to draw supply and demand zones. In this video, I'm going to show you the easiest and probably the most effective way to do it, because we're going to be relying on the volume profile. Now, by using the volume profile, it's going to leave a lot of subjectivity and a lot of discretion out of this technique. And if there's anything you know about being human, is that we make a lot of mistakes and there's a lot of errors. However, if we rely on quantitative methods as well as methods that cannot be argued because they're factual, it can help you increase your accuracy in trading, as well as simplify something that could be deemed more of an art than a science, as drawing supply and demand zones. Now, before we jump just straight into the chart and actually show how we're going to plot out our supply and demand zones on the SPY in this case, I'm going to be dropping a lot of gems in this video. So if you're new to the channel, make sure you subscribe, like the video, share it, especially if you learn anything, and leave some comments down below. If you're interested in learning anything more, I have a Discord, which is linked in the description down below, in which I do go over this in certain private webinars and things like that. Now, taking a quick break from the charts, if you've never studied economics, don't worry, I'm not going to get too in-depth in this, but it's something I feel obligated to have to talk about. What exactly is supply and demand? And what we're looking at is the supply and demand curve on a graph. On the y-axis, we have price, which would be right here, and on the x-axis, we have quantity. So P and Q stands for price and quantity, and this right here is our supply curve, which curves up, and on the left-hand side, we have the demand curve, which curves down. Where price and supply meet is what's known as the equilibrium. So how do we make sense of this? One easy way to think of it this way is when demand increases, so this right here would show demand increases, what happens to price is it also increases because more and more people want the product. There's four main scenarios in which price changes, by the way. I'm not going to go over all the scenarios. I'm going to try to keep this section very brief, as I want to jump straight back to the charts and actually show you guys how to draw your demand and supply zones. However, again, I really want to clarify certain things right here. Whenever supply increases, what happens to demand? It decreases, and the reason it's decreasing is because there's more quantity. In other words, the product is not as scarce. We know, if there's anything we know about human nature, is when there's less of something, people are willing to pay more for it. In certain weird scenarios, we do get what happened last year in 2020. I don't know if this happened internationally, but here in the States, everyone was flocking to the supermarkets and buying out all of toilet paper, and it's not like there was necessarily at the time a serious shortage of toilet paper. It's just because everyone was afraid that toilet paper was going to run up, so that was causing a little bit of a weird chain of events that was going on. But again, in a normal market, assuming things are happening a lot more simply, let's just leave it at that. So what happens when supply decreases? This curve right here would actually shift to the left, and it would end up looking something like this. So this would be the new curve going towards the left. And how do we know it's decreasing? It's because there's less quantity, so it means it's shifting to the left. Whenever this curve shifts to the left, what happens is this becomes our new equilibrium. So where this point lines up right here, we have what would be known as P2, because this would be our new equilibrium for price. And then we would draw a line down here, and this is showing that there's less quantity. So the fact that there's less quantity means it's more scarce, which means price increases, and therefore people are willing to pay more for it. So as you can see, as demand is increasing and supply is also decreasing, that's really going to drive the price up, and it works in the opposite. So keep that in mind, guys. And when it comes to stock prices, it's simply that if demand is outpacing supply, it's going to drive prices up because people are willing to bid a higher price for it. Hopefully I kept that simple, and hopefully it was brief enough for you guys to understand just a little bit of context. I felt obligated, as I mentioned, to show you guys that. So now we jump back to the charts, and we're looking at the SPY on a 15-minute time frame. Let's just jump straight to the 30-minute time frame, which is what you want to use whenever you're using a volume profile. Link to this custom study is in the description down below. Now what I did here is I actually turned off the candlesticks. I adjusted the study, so if you just come to your studies tab after you've installed it, all you have to do is just double click this right here, and I changed the opacity to 100 to really make it vibrant on the chart. And then the next thing I did is, if you come to your appearance tab right here, I clicked the border up, border down, and the fill. I turned the fills off on the candlesticks. I came here, I went to more, and then I actually took the transparency and I made it 100%. So that way we can't see the candles, because you really want to just focusing on the volume profile. That's how we're going to be drawing out a supply and demand zones. And this is going to be one way to really simplify it, as well as make sure you're not doing something that you think is demand or you think it's supply. It's going to be based on where did the market tell you there's demand or supply. So if we start at the bottom of our chart right down here, and let's just turn on this, we can see right here, this would have been a fresh demand zone at one point right here, right? Because at one point the market sold off, and eventually it reached a point in which it was not willing to sell off anymore. The blue area is what's called our value area, and this gold line right here is what's known as our point of control. So it's pretty much just the highest concentration of volume for that day. Each of these volume profiles is on each day right here. So this right here, if I take this, I'm going to extend it out by activating this and just draw it out right here. What do we have is a demand zone, because I'm pretty much drawing a rectangle around all of the volume or the value area for this day. Next, you're going to want to draw out your points of controls, because being aware of where the point of control is pretty significant. And granted, these levels do not have to be perfect. They do not have to be exact. Half the time it's about a general area, but the point of control, while it may not be exactly to the T, also you do want to have your point of control out, because it's going to give you a little bit better of a frame of reference as your level to risk off of. Meaning, if you were to buy in this area here, where do you want to set your stop loss? The point of control will sometimes help you decide on that, as well as give you an actual infliction point for your trade. An infliction point is just if price is selling off into a virgin point of control or a point of control. I'll leave the link in the description down below to other videos in which I've discussed just the points of control. But if price is coming down to this infliction point and you're looking to buy here, you're going to want to be aware of this level, because this is going to essentially be the level in which you're going to risk off of. So in other words, if you're going to take your stop loss at 427 and the point of control is at 89 cents, you need to know that you're probably going to give it about a 1 point stop loss, and you're going to want to be targeting at least 2 to 3 points depending on how you trade. So we have this, what at one point was a demand zone, right? So let's turn on the candlesticks and let's see what happened as price came back down to it. We can see buyers were present in this area, as well as we touched the point of control, and instantly price was rejected off of it, and we ended up flying from that level. Let's go back to our 15-minute time frame without the volume profile on, and we can already see here we had a clear demand zone. Without even needing to look at the candlesticks, we were looking at the volume profile, and it allowed us to have a clear idea for where the market was likely to reverse. Again, nothing is 100% in trading. This is just to help us have a clear idea for where things are likely to happen. And if you trade using supply and demand, that means you're most likely some sort of a reversal trader, because most traders that are momentum-based traders, they're actually the ones that are shorting into a demand zone, and they're not aware of demand because they're just following the momentum. The momentum would have started from the previous day. The market was selling off. It was selling off all night, and they're just trading in the direction in which the market is moving. Whenever you're trading supply and demand, you're probably some sort of a reversion to the mean type of trader. You're some sort of a, you buy the dip or you short the tops, stuff like that, or you short remotely close to the top because you're not going to get it as exactly at the top. In certain cases you will. In this case, if you were willing to wait and be a little bit patient and you didn't buy exactly as it came here, chances are you probably bought within this area here. But buying anywhere within a demand zone is a good idea, and setting your stop loss below the demand zone is going to keep your trading pretty simple. Let's jump back to this and let's keep things rolling right here. If we duplicate this, let's jump into a little bit of the psychology of things. I want to actually skip forward and let's take a look at this area right here. So I'm drawing it again over the value area, and then I'm just going to extend this out. Let's push this forward. In each case, again, I'm going to show different scenarios for different things. In each case, not every time will you use the complete value area. In this particular case, the profile was just really clean right here, so it makes it easy. What I want to show you guys is take a look at what happened here. The next time the market ended up rallying, we ended up getting rejected right at this area right here, and price could not push higher. However, the following day, this was a Friday, the market gapped up over this level, and the market was willing to accept the price higher for this day. But then by the following Monday, as we can see, what happened is the price came right back into this demand zone. Now, without the candlesticks, I know that price came into here because I can see it on the volume profile. This is showing that at one point price was definitely traded in this area. If it's making you uncomfortable because you can't see the candlesticks here, I'll just turn it on so you can see. Now, I'm the type of trader that I like to wait, after the first 5, sometimes the first 15 minutes preferably, and sometimes even as much as the first 30 minutes before I place my first trade. If you end up being very patient of a trader, you'll usually get some sort of a dip buy opportunity, because you have to think about this. There's always people that are very eager to hop in and trade as soon as the bell rings. If you have clear demand zones, to wait to let price come into your levels in which you can take the trade very safely. You have clear levels to risk off of. So if we think about the psychology of the traders that were back back here. At one point, this was a lot of people that were long the market, which means they were buying because they thought the market was going to continue higher. There was also a lot of people that came in here and started shorting the market. And this is why this would be considered an area of supply, because at one point there was too much inventory of this particular product, which would be the SPY. So if there's too much inventory, it means there's too much quantity. There's too much people holding shares at a price in which they don't want. Price gets rejected off of the level and we ended up selling off until we formed a new demand, in which we talked about down here. Price came, bounced off of this level, and then we ended up taking off again. Now on this Thursday, we can see price ended up stalling out here because why? This was a supply zone. You have to think about the psychology of the people that were owning shares from here. They had to hold through all of this pain, and now they're finally excited that they can sell their shares pretty much for a break even, taking no loss. If you've ever bought a stock, let's just say you buy a stock for $100 and you thought it was the best place to buy, and the stock drops down to $90. What do you think is the first thing you do whenever it returns back to $100? Human psychology will tell you you're more than likely going to want to just close the trade because you felt so bad about buying it at 100, holding it down 10 points, that the first time it comes back to 100, you're just happy to get out, move on, and then find a next trade. And that's the same thing that happens to every other market participant. There was a clump of buyers here, and this was their chance to get out of the trade. Now, if we switch back to just a profile, let's rewind for a day, activate this, and I actually want to draw this right here because this, as I mentioned, not every time are you going to use the whole value area. The reason I'm using this area is because, do you guys see how there's a lot more volume traded here? This is a high volume node area. These spikes on the chart right here are what's called volume nodes. This area right here was low volume relative to this clump of volume up here. So in other words, there would be a lot more supply in this area up here than it is during this zone. So this is one way in which you can really tailor your supply and demand zones to make them a lot more tighter, to give you even cleaner, clearer levels. Now, if we jump forward back to this day, take a look at what happened. The market spent majority of the day above this level. Well, sorry, we don't know that the market spent majority of the time above this level because we're not looking at the market profile. That's a completely different subject matter. This is just the volume profile. But we can make the assumption that the market spent majority of the day trading above this level. That means buyers were willing to accept paying higher than this price. Zooming out for a second. Now, whenever you see this type of activity, this is showing that buyers are so strong that they don't really care to let price come back down to the lower end of this demand zone. They're willing to hold price up here and keep bidding higher and higher. This is what's known as a P profile. So as we can see right here, it forms a letter P, and down here this is what's called a B profile. A B profile pretty much is showing how strong the sellers are, and a P profile is showing how strong the buyers are. If you see a P pattern forming above a previous supply zone, that's usually a good indication that price will be going higher. A good rule of thumb is if price gaps out of one of these patterns. So in this case, we had a B pattern, but we can see by Tuesday, the market did not go any lower. We actually gapped up. Whenever that happens, usually you want to wait for price to come into the demand zone. And if it holds, you can catch a nice trade for that day. But in this particular case, the price did not even go back into the buy zone. It ended up just flying for that day, but ultimately we came back down to it, because at this point, this was a fresh demand zone. So what we have right here is a fresh demand zone because we formed this P formation, but the market has yet to come back to this area. Eventually, the market is going to want to come back to 442. If we look at it with the candlesticks on, let's actually zoom out and we can see this is what it looks like right here. So supply would have formed back here, but for whatever reason, buyers were super aggressive and they were willing to keep buying above this zone and drive price higher. And we have yet to come back to this zone. So keep this in mind. If anything, you can pause this video. Be aware of if the SPY comes back to like 442 and 441, there's more than likely going to be some sort of infliction point here, meaning the market would look to reverse off of this level. If we jump back to our profile, same thing works in reverse as I mentioned. Here would be our P pattern, which meant if the market gapped down this day and it was actually below this value area and we could not get back above the value area within the first 15 or 30 minutes of the day, more than likely price is going to end up going lower because this area is going to be a lot of supply. This would be the same thing back here. A ton of people that bought thinking they bought at fair value, or they got the SPY at a good price. Turns out if we gap down, they were wrong. Usually whenever that happens, you have a clear short day for that day, especially if price comes back to the virgin points of control and ends up getting rejected. If you keep your trading methods and really spend the time to understand this, it would significantly improve your trading. I believe for any style of trader, swing trader, intraday trader, scalper, if you have these types of zones and you have this level of understanding of what's going on in the market, it'll keep you out of a lot of smaller trades and you'll end up catching a much bigger moves. The same way like I caught this swing trade on this day from here to here. I also caught a trade from here to here, and then I actually opened up another trade here in which I was targeting 447 on the SPY. So if we jump, why did I take this trade here? Similar situation. Let's move this, the demand zone, activate this, and actually drag this up right here. I'm going to fill up this area, and the reason at this point you guys should know why am I putting it over this area is because look at how high the volume nodes were for this day. This is a huge jump. Now there's a huge jump here at this point also, so this would have been another demand zone in which we would have had up, and as you can see on this day, if price came down to it, we actually bounced off of it at one point. But I want to focus on this one, and I'm not going over the nuances of every single supply and demand zone. I'm just pointing out a few big ones because I want to get to a few other tickers just to show you guys it's not just about the SPY, show you guys how you can catch real trades, especially early in the morning. For some of you guys that are early momentum traders, you can catch some beautiful reversion to the mean, and if you use VWAP as the mean, you can catch some great trades that way. But anyway, let's put back on the candles and take a look at this right here. Here goes our demand zone. Price comes in later in the following week, we end up just barely touching it, and we reverse off of this level. Now, if you trade purely off of price action, you can use whatever method that you look for confirmation for your entry. Usually, whenever you're trading off of demand zones and supply zones, you want to look for usually pin bar candles, as some people call them, or hammer candles. Hammers are my favorite candles to look for. So if you see price come into here and then it ends up closing like this, this is usually a good indication that we're going to go higher, and you can use the pin as your stop loss. So pretty much you put your stop right below the wick. So in this case, a candle like this, let's just say this candle had formed at the lows. It's also dependent on your time frame. I'm pretty sure on the 5-minute time frame there was probably a spike in volume in this area. It's usually one confirmation that I look for. I also use the quant trading algorithm. So this is what price looked like on that day right here on October 13th. So this is pretty much what's referred to as the buy zone. So full disclosure, the link is in the description down below, but I am the lead developer on the algorithm. I use this usually for confirmation on my entries, especially when I'm looking for reversal trades. So this is exactly what it looks like. This is straight from the quant trading app website right here. We can jump back in time and actually see what price looked like at certain times whenever we're looking to backtest or review for certain things, and we can actually see the statistics and data on how price reacted at these levels in the past. If you want to find out more, the website is quanttradingapp.com. It is also the link to the Discord in the description down below. Feel free to message me if you have any questions. Jumping back to the charts, let's just zoom out for a second here and go back to our volume profile and take a look at what's going on right now. So how do we update to current price action? Let's actually duplicate this and move this up here. Put this right here because this would be a fresh demand zone. Let's actually delete this one. We probably won't need it for the time being. You want to pay attention to fresh demand zones. First and foremost, it'll keep your chart very clean, but it's also just because whenever price comes back into a demand zone, whenever it's fresh, it has higher probability of reversing, because the way supply and demand works is this area would be interpreted as there's a lot of unfilled buy orders still here. Price moved so far away from this zone that if there are large institutions that left these orders here, they're leaving them as limit orders, which are passive orders. Price is only moving off of a demand zone when people are very aggressive and they're willing to hit the ask, or they're willing to hit the offer, which is if you're trying to sell something and you're looking to sell a particular product for $10, that's what you're offering the price for. In the stock market, that's called the ask. You're asking for $10. If I'm a buyer and I'm willing to buy it for $9 and I put a limit order for $9, I'm considered a passive buyer because I'm not willing to meet the ask, which is the price that you're asking for. This is what happens in the stock market, and this is what drives prices to move. It's not that there are more buyers or there are more sellers. It's just who's willing to compromise and either step down to the bid or step up to the ask. Whenever there's institutions that are putting out a lot of orders, chances are they're not finished having all of their orders filled, and that's what creates this zone for if price came back into in the future, it's likely to bounce because their unfilled orders will look to get filled here, and we're just trying to take trades alongside them. Next, you'll obviously want to do the same thing. Let's just duplicate this right here so we don't have to keep redrawing the same levels, and then drag this up and leave it right there. And this would be our point of control. In this particular case, since it has not been touched, I usually just renamed it. I put a V in front of it so that way I know it's a virgin point of control, which means it's a much stronger point of control because it has not been touched before. So this right here would be our most current demand zone as well as our most current virgin point of control. And if the SPY came back to this level, I'm definitely going to be looking to take a trade off of it with a stop right below the demand zone. Whenever you're taking these types of trades, I'm referring to day trades. If you're taking a bigger picture trade, you're not going to want to stop out of a trade like this because there's going to be another demand zone right below it and another VPOC. So if anything, the VPOC, by the way, is virgin point of control. So another VPOC right here, you're probably going to use this as a place to scale in. So if you scale in here and you scale in here, you're not going to take such a tight stop loss because you could be targeting all-time highs on the SPY. So as we zoom out, I'm just going to fast forward the video and you guys can just sit back and watch me plot out all of the virgin point of controls, all of the demand zones, and then take a look at what the chart will look like when we're done. And there you have it. So here are the demand zones for the SPY and the current supply zone. So I color coordinated it just to make it very easier to see, which is what I usually do. And the green obviously stands for demand and the red stands for supply. Now, what makes a zone demand? Pretty much if price is hovering here, then this would be considered demand because we are above it, meaning if it came back, there's more than likely going to be unfilled orders here, and therefore there's going to be demand. There's people that missed out on buying here, so they want to buy when price comes back to here. So demand zone. And this right here would be our supply zone. So assuming the market gaps down tomorrow and then we push up and then we can't break through this level, we're more than likely going to sell off and come back down to the most recent demand zone. That's how I plot these levels out. This is how I trade them in confluence with the quant trading app algorithm. Whenever there's confluence in these zones, I love taking those types of trades. I sit back and I trade exclusively around VPOCs and levels from the algo. And whenever a level is touched, I would take the V off and I'll leave it as a POC. And then if I see that it's just not in play anymore, I'll remove it so my chart does not end up looking too cluttered. If we go back to our candlesticks, now we can see how much more comfortable this looks right here. And it's an easy way to have a clean trading plan because it's all color coordinating. I just have to sit back and wait for price to come towards me. Now, I mentioned I wanted to go over a few other tickers, but then I just looked at the time and I didn't realize I was recording for so long as I went over a few things. I went over more than I actually intended to go over in this one video. So I'm going to treat this one more as an introductory video to show you guys how to plot the levels and the supply and demand zones on your charts properly. And then there's going to be a quick part 2 to this video in which I'm going to go over the Qs very briefly, but more importantly, Tesla, Apple, Nvidia, and Facebook. So you can see some live examples on individual tickers. That's not just an ETF like the SPY, which some of you guys might not even trade. But I would encourage you to always do it on the SPY, the QQQ, the Dow Jones, which is DIA, and the IWM, which is the Russell. Because if you have a good feel of what's going on in the broader markets, it will help add confluence to the individual tickers in which you trade. So in other words, if the SPY was in a demand zone and you're looking at a bull flag on Tesla, and it's forming this pattern right here, which would be a bull flag, and it's actually on the lower end of the flag, and you see the SPY is actually at this infliction point and it's reversing, that might add confluence for you to actually buy Tesla right here and then catch the breakout of the bull flag. However, the same thing will work in reverse. If the SPY actually sells off here and we come back up to this infliction point and it's struggling and then it ends up breaking down, if you see the same bull flag on Tesla, you might expect it to break down, and if it actually breaks, it might prevent you from taking a loss on this setup. So that's why having these up, I would suggest you always have this up on a monitor, always have it up on a separate screen if you can. If not, just swipe over and check it periodically. Set your alerts. So just right click on your chart if you're using Thinkorswim, press create alert, and that way you'll be notified whenever price hits these zones. So that's the end of this video. Again, stay tuned to part 2. It should be coming up right after this video is live because I'm going to talk about the current price action. I don't want to end up uploading it too late and you guys end up missing out on some great trades that could presumably come very soon. So catch you guys in the next one. Thanks for watching. Leave a comment down below. subscribe to the video, like it if you learned something, and don't forget to share it.